There's a little pattern that almost every Australian falls into, and it's the reason most people stay in debt far longer than they need to. If you're watching this, there's a good chance you're looking at buying, building, investing, or developing. Or maybe you've already started the process and something feels confusing. Most finance disasters don't happen because people are irresponsible. They happen because you don't understand how lenders actually look at finance, your behavior, and your decisions. Banks don't just look at your income, they look at patterns, they look at habits. And sometimes what you think is the smallest, most innocent decision can quietly destroy an approval without you realizing it. In this video, I'm going to walk you through some of the most common mistakes I see people make when applying for finance. Some of these are things that I've seen my clients do. Some of these are things that I've spoken to other brokers about and they've seen, and some are from other people in the same industry. And one of them is a pretty painful mistake I made myself before I was even in the industry. This isn't about judgment, it's about awareness. If you can understand these mistakes before you make them, you can be miles ahead of other people. Hey, I'm Aaron from APAC Finance Solutions, and let's dive deeper. So our first is Afterpay and buy now, pay later type loans. Most people think of these as just small little harmless loans. Some people don't actually even think of them as loans. I want you to think of any time that you owe money to someone else, that is a loan. And that might sound simple to some, but it does come up quite often. When servicing is tight, lenders view these as a warning sign. If you're using buy now, pay later for everyday purchases, it tells the lenders two things. One, you're accessing credit to pay for day-to-day purchases. And two, you may not have a true handle on your spendings. I once had a client who had a $1,000 Afterpay sitting there, and he didn't realize that it was actually treated like a credit. Because you have access to that money, even if you don't have anything on it right now, it's still access to a debt, and the lenders will see that, and it will hurt your servicing. This isn't about being irresponsible, this is just being unaware of how the system works. Buy now, pay later isn't evil, it's a tool like anything else. However, if you're preparing for finance and servicing is tight, it's definitely something to try and get rid of early. The next thing that destroys serviceability quite commonly is lifestyle spending. And I say this with the warm heart because almost all of us fall into this trap at some point. Uber Eats, DoorDash, Deliveroo. The convenience is brilliant, but lenders don't see convenience, they see a spending pattern. During assessment, banks often highlight recurring spending. Things like multiple Uber Eats orders every week, high frequency of takeaway, impulsive weekend spending, and entertainment spikes around payday. These things don't just reduce borrowing power, they tell the lender a story about your spending. Quite often when we have these conversations with people, they actually have no idea how much they're spending every week. And that's why we recommend you look at the MoneySmart budget tool. It's one of the best free resources available, and people can see their numbers in black and white. Lenders aren't expecting you to be perfect, but they do want to see consistency and control of your money. If your statements look like you're funding the local takeaway economy, it might be time to have a deeper look. So the next one is one of the biggest mistakes I see quite often talked about online, and it's a mistake that I personally made when I was quite young. People assume that paying off all debts is always good. Sometimes yes, sometimes no. Everything depends on your overall goal, always. It also depends on timing and structure. So I've had people come to me really proud that they paid off all their loans, all their small credit cards and everything. And that is good, that's a great thing. However, if your goal is to own a house and you now have zero deposit, that might not have been the best decision in that moment. Now, there are different factors when going for a home loan, and a deposit is one of them, and it's a huge one. Without any deposit, it is very hard to convince someone to give you money. So before you start transferring money and start paying everything off, I highly recommend you speak to your broker first. It can save you months of setbacks. Another problem that I come across quite often is new loans and new purchases during the settlement. So once you have a pre-approval or you're in the process of buying, you must not take out any new credit. If you're going for a home loan, no personal loans, no car loan, no interest-free deals, no Harvey Norman, no repayments till 2072 offers, no credit cards, and no new finance furniture. Any big purchase that requires more debt can put everything at risk. One of the most painful situations I have witnessed is someone buying furniture just before a settlement because it was on sale and he really wanted it. The bank saw it and the computer said no, and settlement almost fell over. If you take on any debt after the approval, the bank can pause, freeze, or cancel the loan entirely. It's not personal, it's just risk management from the lender. Your job during this process is simple. Just stay still, don't rock the boat. Keep your finances consistent, and if you have any questions, always reach out to your broker. Another common mistake is changing jobs either right before applying or during the settlement process. Sometimes people assume having a higher income will make the bank happier. This is not the case. Lenders care more about stability than the overall top number. I know this one can be hard. You can stay in a job that you don't really like that's paying lower, and a new job offer pops up, but I highly recommend you talk to your broker and find your overall top goals before making the decision. I have seen people change jobs and then lose the buying window that they were hoping for because the lender now wanted another 3 months of income from that new workplace. There are actually a lot of lenders that have different policies on these type of things. If you are thinking about changing jobs, timing is everything. Sometimes we can still make it work if you choose the right lender, and sometimes we might have to hold off and stay in the same job just to get it across the line. And sometimes you might want to take that new role and then put off buying the house for a bit later. That's fine too. But in general, if you are looking at going for a loan, try not to change your employment without running it past your trusted professionals first. This next one happens a little bit more than you think. People trying to hide their dependents to improve their borrowing power. Lenders find these quite often, and it comes up all the time. Centrelink transactions, Medicare cards, childcare fees, there's lots of things that pop up in the bank statements. If you say you have no kids, but then you're spending $400 a fortnight on childcare, the bank isn't going to think you're donating to some random child. They're going to assume you are supporting a dependent. Banks don't judge you for having kids. However, they do judge you for dishonesty and omission. Dependents do change your borrowing capacity, that's correct, but trying to hide them can create far bigger problems. Always be upfront, find someone you can trust, and lean on your broker. We can't help you if we don't have the full picture. So this next one is based on trust. Trusting your real estate agent or trusting the seller. And then finding a broker you believe you can trust and then not trusting them by hiding things. So again, this isn't a judgment thing. This is a looking after yourself first thing. Real estate agents work for the seller. That is their role. Their job is to get the best price, the best terms, and the strongest contract for their vendor. Great agents are upfront and honest, but the reality of this is nothing is binding until it's on paper. I have seen buyers spend money on things like building inspections, pest inspections, valuations, and legal reviews before they have anything signed and on paper. I have had stories of people being told, yeah, the property's yours, and they put in their offer, and then a day later they find out someone bid 200 grand above them. And this devastates people. If nothing is on paper and nothing is signed, you do not own anything and you are not guaranteed anything. Before spending any money, make sure you have a signed contract. I've also seen people try and hide their deposit from their broker. Now, the way I see my role, I'm an agent in between lenders and yourself, and I work for the borrower. I'm not trying to take all of your money. I want to do exactly what you want to do. And if it doesn't work, we wait until we find a strategy that does work. Trusting the seller is another one that's come up recently. I was sitting with a colleague who's a conveyancer, and she mentioned that she had a client recently come up to her and say, I know all about all the problems. The seller told me everything. We don't need to run the usual checks on this particular property. Now, this conveyancer said, no way. If you want to work with me, I'm running the searches. So the problem that they were aware of, which they thought was a $30,000 pool problem, turned out to be that the pool was actually on the neighbor's land, and it's going to be a $300,000 problem. So they did pull out of the purchase. So again, trust the people that you have paid to do the role that they are doing. That moves us on to the next one, which is hiring your conveyancer too late. I believe that the conveyancer is one of the most underrated people in the whole home buying process. People often wait till the very last minute to hire the conveyancer just for the settlement process. But by then, they don't have to do much work. It's just a transfer, and all the damage could have been done already. You should include your conveyancer or solicitor prior to signing anything. They know exactly what to look out for. Unfair clauses, missing protections, unusual conditions, settlement risks, title restrictions or easements, access issues or zoning complications. Most buyers don't understand half of these, and you're not supposed to. That's why experts exist. Depending on your conveyancer, a lot of them actually charge a set fee for service. I highly recommend you engage your conveyancer early in the process. It's a small cost in the scheme of things, and it can save you thousands, like the story I mentioned just a little bit earlier. This next one is my own story, the duplex build disaster. So before I got into finance, I made a huge mistake. This was early on in COVID, when all the builders were overloaded. Every stage took far longer than expected. Payments were taking weeks to clear every time, and builders had so many projects on that if you fell behind in a payment, you would go to the bottom of the list, and then the delays would flow on from there. When we got the final payment request, our fear of delaying things even more, because it had already been a long process, got the better of us. We approved the final payment without doing the final walkthrough, which is a horrible mistake. That decision, thinking that it would take 2 weeks for it to clear and we could inspect in that time, caused months and months of headaches. When we finally inspected the property, I won't go through the whole list of what there was, but there was a brick missing on the side of the house. Not cracked, not loose, missing, as if someone had taken it home as a souvenir. The front door keys didn't match the front door lock, so that left us standing at the front trying to get into our own place and looking like we were breaking in. The list of defects were large and long, and correcting them took well over a year. The lesson here is simple. Don't let fear rush you. Don't let anybody rush you. Never release a payment without confirming the work. And always do a final inspection. It doesn't matter how behind the builder is or how much people push you. Protect yourself first. So we're going to finish off today with some simple habits that could improve your approval chances. Some fundamentals that might make a massive difference. Number 1, create a simple budget. Doesn't have to be complicated. Just know where your money is actually going. I'll put a link in the description to one from Money Smart, which is a government given one. Number 2, clean up your spending pattern for about 3 months before actually applying. Lenders look backwards, they can't look forwards. Number 3, avoid any new debt during the process. Even the smallest change can make the lender rethink your risk. Number 4, keep your income stable where possible. Consistency always beats volatility in the bank's eyes. Number 5, have your team in place early. Find your broker, your accountant, your conveyancer, or solicitor, so you're building a strategy and not just winging it. Number 6, ask questions. Nothing you ask is silly. The only risk is you not understanding something. As a broker, I don't charge for service, and I like my clients to book in as often as possible. If there's a space there, please book in and ask any questions you have. And number 7 is to get advice early. You don't need perfect finances to start. You don't need to be fit before going to the gym, but getting the right information early can help steer you in the right direction. When you combine these tips and habits, you may present yourself as a more ideal borrower. Reliable, stable, and financially aware. This is what lenders reward, and it's what helps you stay ahead of the game in the long run. Thanks for hanging out again. Aaron from OPAC Finance Solutions.